First part is, why do people sell? Right? I ask this question every day with the newer agents on my team, with our clients. Why would you sell? For most people, for first 10, 20, 30 years of owning a building, it doesn't make any sense to sell. Right? You own it, it does well to own it, and you keep the building. But people sell because they're sick of property management, right? The toilets and termites just drive them crazy. They say, I don't want this anymore. I'm moving to Florida. Let's get rid of the building. They sell because they've completed the business project, right? They bought a vacant building, they leased it up, and now it's time to sell because they've taken on an upside, or sometimes the opposite of that as well, right? They own an occupied building, now it's vacant, you sell it to an owner occupant, they can come in and use it for their business. A lot of people sell because of lifestyle reasons, the so-called 4Ds: death, divorce, partnership dissolutions, and disease. Certainly, at some point we're all going to go through, at least the first one of those Ds, and it's something that we want to plan for. I'll add the caveat here. You also want to plan for that gap, right? I think a lot of people say, well, I'm going to keep this and give it to my kids, and then they can sell it. The reality is, for many people, for most people, if you're lucky, you go from 62 and healthy to 70 and kind of slowing down, or 75 and slowing down, to 85 and passing on. And there's this whole gap there where the building needs to be run if your plan is to give it to your kids. It's a great opportunity to bring in someone like Bob that can run the property if your kids don't want to. But I think a lot of our clients forget that, right? They forget that you don't just go from being, the guy that can do everything to, the guy who's giving it to his kids. So that's an important thing to plan for the 70s and 80s. Those decades of your life, you may not want to be chasing tenants around, and it may not be time to give the property to your kids yet. And then certainly estate planning, right? Do your kids want to own the building that served you, that maybe made you wealthy, that was a great investment for you for 10, 20, 30 years? Maybe your family business was based in that building. Do your kids want it? Maybe the answer is yes, right? If this building's in Framingham and your kids all live in Framingham or Natick, and they've got some interest in real estate, or they're contractors, absolutely keep the building, give them cash flow. It's a great thing to give someone. If your kids are attorneys in California, they probably don't want to own a 30-tenant building in Framingham, and you're better set up to hire property management, to do the 1031 exchange, to sell the building, than someone that knows nothing about real estate. We get called by the heirs all the time. They say, hey, I just inherited this building. I don't understand it. I don't have any of the leases. I need to get rid of it. So at minimum, really you figure out, do your kids want it? If they don't want it, go ahead and sell it now. Do a 1031, figure out what makes sense for them, right? Which may not be the same thing that made sense for you. At minimum, though, make sure you put together a good file, right? Get the leases digitized, find the plans, explain to someone in your orbit how this thing works, because we see people all the time inherit a building and they have nothing, and you end up in a lot of bad scenarios when that happens. And we want to see our clients sell because they want to, not because something's gone wrong. Where do people mess up? I already touched on a couple of these, but certainly a lot of people pay massive tax bills. We're talking multiple seven-figure tax bills when it didn't make sense for them to do that, right? Where they could have done a 1031 exchange and gotten into some good cash flow. Maybe they could have done a 1031 into a DST or some other tax planning strategies. They keep the building too long, right? People keep a building that no longer is an appropriate risk return profile for them. If you own a 100,000 square foot single tenant office building in a secondary market, and you're 75 years old and you're living off the income, you may not be prepared for what happens when that tenant leaves, right? That building may not be an appropriate investment for you, where it is still an appropriate investment for, let's say, a fund that owns 100 buildings, where if that building's vacant, the other 99 are still supporting that fund. So a big part of real estate is being invested in the right real estate for your stage of life. And that's both the real estate that has the right risk profile for you, and then also the real estate that offers obviously the right return and the right kind of balance of headache to cash flow, right? When you're 35, taking on a lot of headaches to make an extra couple bucks might be worthwhile. when you're 75 and you have all the money you need, I think for a lot of people, it'd be better to spend that time with their grandkids. And then the final one, the 1031 exchange is oftentimes talked about as this panacea by brokers. I've done this at times in my career. But if you're going to do a 1031, make sure you're not jumping from the frying pan of taxation into the fire of being over leveraged on bad real estate. You don't want to have a big loan on a building where a not creditworthy tenant goes bankrupt on you and you don't have any way to pay the mortgage. So it's really important that when you're looking at 1031s or you're looking at Delaware statutory trusts or frankly any kind of investments, that you make sure that you're investing in something that's appropriate for your stage of life and that's good bricks and sticks, good credit, good real estate. You don't want to buy bad real estate and lose the money that you took 20, 30 years making. And this I've talked about a bit already. Vacancy risk, really understanding asymmetrical risk. Our friends in private equity will talk about, can I invest $1 to make 10? We see some buildings where if things go right, 5 million turns into 6 million. And if things go wrong, 5 million turns into 2 million. You want to really understand the risk profile of the deal, because if you're in one of these asymmetrical risk scenarios, it may make sense to sell for 5 million today and go invest somewhere else. But just understanding how long of a commitment you need to be making to the asset, right? If it's worth 5 million, you can get to 6, that's totally reasonable. But make sure you have the time horizon to do that, and to do that in the event that maybe one of your tenants doesn't renew and you've got to fight to get back up to where you were and beyond where you are, right? We think real estate, almost every piece of real estate I see is a great investment on a 10-year time horizon. A lot of real estate is a questionable investment on 2-year time horizon. So what are the other options, right? I'm an investment sales broker. I make money when people sell their buildings. That's where we get paid on the point of sale. However, great options, and we've introduced people to these options countless times. Hire a property manager that can do the work for you. We had a gentleman that owned a probationary office in Massachusetts, single tenant, 10-year lease, but it was a gross lease. He had to do the management for the state of Massachusetts. Wanted to give the property to his daughter. Gentleman was in his 80s. We were able to introduce Bob Bowen and his team at Eastport to this property. Now the gentleman makes a little bit less money, right? He's making a few bucks less, but he's got a 10-year lease. He's collecting the cash flow. He avoided the taxation. Bob and his team also were able to educate the daughter on the building. They were able to take the handoff. And now if something happens to dad, the daughter will inherit a smooth transaction as opposed to inheriting a big pile of paper that she doesn't know what to do with. The 1031 exchange is a great option for a lot of people. I'm not going to go into that. Kent can talk about that. There's also what we call the lazy 1031 exchange that Kent taught me about. That can be a good option for some people that the timing doesn't work out on a 1031. And then sell the property, pay the taxes, and effectively invest that money, whether it's in fixed income, in the stock market, and Bitcoin, and house for your kids, whatever it is. But certainly for some people, selling your building, paying 30% capital gains taxes, and then having the money liquid in another investment that's not real estate can also be a reasonable investment. All right, now I'm going to hand this off to Bob, who can talk a little bit about what he does and about property management. Yeah, Bob.
Yep. Thanks, Harrison. Great job. That client that you mentioned in Natick is a great example. Elderly gentleman, lives out of state, has a daughter that wants to be in the business, and they didn't want to sell, but they didn't have the sophistication to take it on. So Harrison was kind enough to introduce us. We took it over, and we do all the blocking and tackling and the day-to-day. And that owner stepped back and really became an asset manager. And I'm going to talk about this a little bit, but we see all walks of life where we have this big spectrum of client where on one end it's I'm going to Florida, as Harrison mentioned, send me my quarterly distributions and call me if you need me. And at the other end we have like super involved. I actually just came from a meeting with a client that's still involved day to day, every day. And so it's really everything in between. So just a little bit about us first. Been in business for 31 years, 32 years. And um, I came along 20 years ago and took over the company from my business partners. 10 million square feet under management. I think now we're up to 11 or 12. It's been growing pretty swiftly. 200 plus properties of all different types. We do office, retail, medical. Try to stay away from residential for obvious reasons. It's a little bit of a different animal. And we're really all over New England, and we do go where our clients go, provided it's if it's retail or flex, we can manage it anywhere. We have offices in Wakefield, our main office, and we have offices in Metro West. Last May, we became the largest third-party property management company in Worcester, so our business is booming out there. And you can see some of the on the slide here. We collect a lot of rents. We have 10 property accountants in-house. We do a lot of financial reporting from simple balance sheet and income statements to institutional grade reporting and everything in between. We're up to 55 employees. So we're still a small company, but getting up there, as you can see, we're on the Business Journal top 10 in size, but that's really a dubious distinction where the top 5 are the international behemoths of CB and JLL, and we're number 10 down the list at 10, 11 million square feet. What I'm most proud of is we're regularly on the best places to work for the Business Journal, just because, as a lot of our clients know, property management is not easy. It's a hard job. It's 24/7, and it's a tough way to make a living. But if you have a great culture and you love the people you work with, it just makes it all that much easier. And then we offer property management services. Here you can see a copy of our org chart. We have maintenance technicians. We do construction. So a little bit of everything related to commercial real estate. Even tax abatements and lease writing. And we take as much or as little off your plate as possible. Interestingly enough, I'd say over the last 3 or 4 years, we've seen our typical client now is what Harrison described, where somebody's maybe in their 70s or 80s, they've owned these pieces of real estate for years, and they're ready to take a step back. And some of them have family offices that they're disbanding, and we've adopted some of the employees to keep them on staff, to keep the properties operating as the client wants. And it's really been an interesting ride, because it's family offices, baby boomers, and what the consistent theme is. Harrison oftentimes makes the introduction, and it's, I've owned these buildings for 30 years. I'm done doing the day-to-day. My kids are successful or don't want to be involved in it, and we take it over. And again, the client steps up into the asset management role. And I'm going to say on a number of occasions, the kids who are in their 20s to 50s are on our weekly or monthly calls, and they're learning the cadence of what we do in the decision making. And sometimes their 5-year plan is to take it back in-house when the child gets sophisticated enough, but others they have their day job, they have their hobbies, and they just want to be part of the process. They're not in the process like we are. Again, we take over all facets. Work with a lot of the brokers that come with the property, and oftentimes, the proverbial brother-in-law is mowing the lawn or plowing the driveway, and we take that on. As long as the client wants it. So it's really interesting times with what's going on with a lot of these I'll call them legacy properties. And as you can see here on this slide is just an example of some of these properties up in the upper left-hand corner. It's a mixed-use building in Andover owned by a local syndicate group. The Worcester building is a large group of investors, and then the bottom two are for a large institutional client. And those are on the periphery of what we do, but I'd say the vast majority of our clients are individuals or families that they're just done with the day to day. I'll just go back to, managing properties is not for everybody. You're buying and owning the property for investment and for income, and not necessarily to make sure that the sprinkler gets tested every year. But that's what you hire property management for. So I will leave it at that and kick it over to Kent. And thanks, Harrison. I appreciate making me part of this webinar.
Hey, Bobby, I had a couple quick questions for you.
Sure.
One of them, what is the owner's involvement with you typically? Let's say it's the legacy owners. How often are they talking to you? How much do they still need to do, right? If they're considering this versus buying a net lease property, how much of a pain in the ass is the property still for them if they hire you?
Really, that's up to them. And I'll go back to, we have clients that, they're in Palm Beach and they hand us the keys and say, I'm going away. I'm going to follow my passion and golf. Or I'll give you one great example. We have a very successful former dentist who retired, and he's a sailor, and he was running the day-to-day operations of his building. He owned the real estate and the practice and sold the practice, kept the real estate. And we met, and he is now literally sailing the world, and we send him the net cash flow on a monthly basis, and he leaves it all to us. And we email him and keep him in the loop. And if there's a asset management level decision to be made, we talk to him, but he might be in a different time zone. And on the other end, we have clients that can't let go. This is their livelihood, their baby. They've owned it for 30 years, and it's daily, it's weekly meetings, it's text, it's emails, it's heavy involvement. And it's everywhere in between, Harrison.
Awesome. And then my other question, you guys are able to do kind of tenant selection, tenant management as well, right? So you can take those tenant calls on maintenance, but you can also do, finding me new tenants, you're kind of dealing with lease renewals, things like that as well, right?
Yeah, we do. We have a broker license, but we're not out being a broker. We're first and foremost a full service third party property management company, but we do get involved very often in lease renewals, expansions, and even acquisitions. This property on the upper right hand that you're seeing on the screen, we deployed over $100 million of our clients' investment dollars to find, source, do the due diligence, and soup to nuts management, even negotiating the leases, hiring the brokers, and acting as asset manager. And then we report to that institutional client on a quarterly basis to report on what our pro forma was at the time they purchased property. So we can do institutional level, for purposes of this webinar. That's a service that we offer, and we have the skill and expertise to do. But the really interesting market shift is these baby boomers that are just ready to go to Florida. And it's really interesting because weekly my phone rings, my email goes off, and it's almost comical that the script is the same. I'm ready to step back. My kids don't want to be involved in the property. I don't necessarily want to sell, but I like the cash flow, and we just make it easy for them. We want to be able to see their bank accounts. That's really the biggest hurdle, because the way banking is now with cyber fraud and all that sort of thing, the banking up front is a hurdle. But we have a great process, and everything is a process because it has to be systematized, where when we onboard a property, we have a great welcome letter for the tenants to let them know that, hey, we're here, here's who you call for service, here's who you call for renewals. And we really take, a lot of it, you mentioned that it's up here in their head, and it's not, the leases maybe are scattered in a box somewhere. We create processes, we create systems, and we make that transferable, that if they ever want to take it back in-house, they can. But over the course of my time here, and the company has been in business 30 years, we still have clients that we started with from day one. Our typical client base is not a buy, hold for 3 years and sell. We do have some of those, but most of them are buy, hold, cash flow, pay down the debt, and be able to go through all those. We talked about those points in time where You had the dot-com bubble, you had 9/11, you had the mortgage crisis, COVID, and now what's going on in the world. All those ups and downs, we help our clients navigate all those, and we love it. And we become close friends and confidants of the clients because we're talking to them, and it's a relationship business.
100%. I appreciate it, Bob. And we'll send out this slide deck to everyone as well. Yeah, I'm trying to find your slides, but let me introduce you while here we go. So Kent's local in Natick, Wayland, but yeah, he's in the Metro West market. He's been doing this for a long time. Every time I talk to him, I learn something new about taxes. More importantly, how to pay less taxes. So if you want to pay less taxes, he's a great guy to hang around and learn some of these strategies. I first met him as a DST person. So I'll let him explain the DST process, but it's something you can do with your 1031 exchange money. But beyond that, he's done a lot of other interesting tax strategies for people. One thing I'll add, personally, that I always try and run by him, even for someone that doesn't want to do a 1031 exchange or has lost their window for the 1031 exchange, there can be some good opportunities in oil and gas futures, in equipment rental. There's all these things out there. I guess not in the club to know about, but the Kent knows about. So it's always, if you've got a windfall coming in outside of your kind of normal what you're making every year, he's a great guy to speak to and spend 20 minutes and learn, hey, is there a way I can save some money in taxes here? Because oftentimes there's ways on a big $5 million windfall, you might be able to save $1 million in taxes, or at least defer them long term. Kent, you there?
All right. Yes. Thank you for teeing me up here. And I think I'm going to rip through my slides pretty quickly. And I guess you or Liz are going to have to advance it for me. But I thought a good place to start to kind of leave off where Bob kind of the shift from active hands-on to passive. So I think if what I want to level set with people is, if I do decide it's just not for me, I don't want to outsource property management, I'm done. But what are the taxes, or what are the tax ramifications of me just selling outright and going playing golf in Naples? Because they can be significant. So I think the best way to start or frame this without geeking out too much is to describe to everyone that there's really three categories of income. There's multiple categories of taxes, but you have non-passive, which we'll refer to as active. Think of that as your wages for work, your ordinary income, whether it's W-2, maybe you're a K-1 partner in a law firm, or 1099 independent contractor. You have passive income, which all rental real estate is passive. Or let's say I'm a limited partner in a GP-LP investment, maybe royalties, other examples. So they refer to those as PIGs, passive income generators. And then thirdly, there's portfolio income. Think of dividends, capital gains, interest. So each of these are siloed because I can only offset active income with active losses or deductions or credits that apply to that lane. And the same thing with passive income, I can only use PALs, so pigs and PALs, passive activity losses. And then same thing with portfolio income, there's only certain offsets that I can use to that. So I might be a good W-2 earner in category 1, or I might have a massive passive portfolio in category 2. And so I need to be thinking about, on the exit, what am I tripping or what am I triggering? And in that middle category, I do make reference to a couple on the checkbox. May be hard to see because it's kind of small, but when I can supersize a passive loss and I can materially participate, there's 7 tests in the IRS code in the green, then I can basically use those supercharged losses or credits or deductions. Oh, we just lost our screen there. There we go. Against my ordinary income. So it really depends upon someone's pain point. And the 3 or 4 I just will point out is, like, if someone has a short-term rental, there's a short-term rental loophole where, as long as I materially participate, I may be able to take that type of real estate and use that to offset my active income. if I meet real estate professional status, which I think most people assume I have to be a real estate broker, like Harrison. That's not true. There's 11 trades or businesses that qualify, but I still have to materially participate. Or I can do grouping elections where maybe I have a portfolio of properties and I want to get those hours cumulatively. I can use these grouping elections. But again, without getting too far in the weeds, Harrison, I'll have you go to the next slide. So if I was contemplating a 1031, it's not eliminating tax, it's deferring tax, because ultimately the expression swap till you drop. So when you die owning real estate, you get a full step up in basis. So you've outwitted the IRS, but you had to die to do something. So your beneficiaries are going to be your heirs will be the beneficiaries of that. But what are the taxes? Well, there's really 5 potential taxes. So one is the federal capital gains tax, which is either 0, 15, or 20%. I'll share that a little more detail with you on the next slide. Second, which I think a lot of people forget about, is the net investment income tax, which kicks in over $200,000 for a single filer or $250,000 for a married couple. So that can very quickly start adding up. Then we have the state income tax or state capital gains tax. In Massachusetts, it's 5%. It depends upon your state. The highest is California at 14.4. I know New York is 13.7. Massachusetts, we're really 9% with the millionaire's tax. It's the 5 plus the 4. Then here's the other ones that I think a lot of people forget. So I think the assumption is if I took depreciation, I own this asset for 27 and a half years whether it was residential or non-residential for 39 years, I may have fully depreciated that. So that's adjusting my original basis. So everyone assumes the tax is 25%. Well, it's not. There's actually 4 tiers, 10, 12, 20, and 22 before 25, but it's capped at 25. And so that's basically where I took depreciation, Schedule E of my return. But here's the gotcha one, because I think a lot of people, especially in the commercial space, do cost segregation and bonus depreciation. And with the one big beautiful bill bringing back 100% bonus depreciation, anyone that has an investment property would be foolish not to take advantage of cost segregation, moving elements of that property into 5, 7, or 15 years, where then I can bonus depreciate the whole thing. Well, that's a fantastic tax deduction, and if I meet that material participation, like we mentioned in the last slide, I can have some massive tax savings for my ordinary income. But what happens is when I go to sell that property, I'm going to be triggered with ordinary income for that recaptured depreciation. So if I execute a 1031 exchange, I might be able to defer the first 4, but I need to make sure that the new property, whether it's a fee simple real property, or I'll talk about Delaware statutory trusts in a minute, has done a cost seg, so that way I have a catcher's mitt to, again, defer that tax. And if you, next slide, Harrison, please. This is just a visual representation of our tax table. So I'm showing in the first column, this is a single filer, and then to the right-hand side, it's married filing jointly. So you can see there's actually 7 tiers from 10 to 37%. But then I think a lot of people forget about long-term capital gains. Short-term capital gains is taxed as ordinary income tax. Long-term capital gains is either 0, 15, or 20%. And I think people assume I'm going to pay all my capital gains at 20%. Well, that's not necessarily true, because I'd have to be earning over $613,000 as a married couple to be forced into the next bracket up, which is 20%. So our tax system is a stackable system. And then on the far right, the third column is basically expressing this net investment income tax, which on anything that's passive or portfolio income, this is people talk about being in a 40% tax bracket, because they're taking 30%, 37% federal plus 3.8% net investment income tax. On the next screen, I'm going to just very quickly give an example. I know there's a lot of fine print here. So the description is, it's showing someone who bought a property originally for $400,000 and they sold it for $1.85 million, not too off the mark. They've taken depreciation over a number of years, so their adjusted basis is actually $165,000. So their actual capital gain is the difference between the selling price net of fees of 1.85 million and my adjusted basis of 165,000. So that's almost a $1.7 million capital gain. Well, to simplify things, between depreciation recapture, the federal capital gains, the net investment income tax, and the state tax, and I'm ignoring the cost segregation in this particular example, that is nearly a third in taxes that are going out the window. If I executed a 1031 exchange, all of those taxes go away. They get deferred. If you go to the next slide, please. So this is what we call our decision tree. So the left-hand side basically says, okay, I'm going to pay those taxes because maybe I have other strategies that Harrison referenced that I'm going to address that, or maybe I have a big capital loss carry forward that can offset some of that. So I'm going to pay those 5 different taxes, or I'm going to take the right-hand side and say, well, listen, I'm going to do the deferral. I'm going to execute a 1031 exchange. I need to engage a qualified intermediary to take constructive receipt at that closing. Now I have 2 paths. I can either continue as an active real estate, and Harrison, you had the 4 Ds. Well, I have the 4 Ts, which are the terrible Ts. Tenants, termites, teenagers, taxes, in some cases, or maybe I have a great property manager like Bob, and he deals with all those issues. Or I want to take this passive approach, which is using the Delaware Statutory Trust. If you could go to the next slide. So a Delaware Statutory Trust is a securitized form of real estate that came into the code. You can stay there for a second. In 2004, as a vehicle, as an alternative to tenants in common. If you remember, tenants in common are a very common ownership title. You can only have up to 35 owners. Everyone's individually underwritten. There was a lot of lawsuits fighting whatnot. And what a DST was brought into was when I want to have fractional ownership in real property. The DST structure was introduced in 2004. If you go to the next slide for a second. So there's 2 paths, which I'll show you in just a minute. So there's what I'll refer to as the securitized form of Delaware Statutory Trust, which I think a lot of people are familiar with, where you may have an institutional sponsor, let's say a Blue Rock, a Capital Square, an Inland, maybe Apollo, Griffin, that are big institutional managers, and they are in all the same food groups that you can invest in, whether it's multifamily, office, student housing, senior housing, energy, industrial, storage. Where that marketplace last year was about $8.5 billion. There was over 89 funds created by 50 different sponsors. And what you need to understand is some people say, well, gee, I'll buy a REIT or I'll buy a real estate mutual fund. Well, those don't qualify because you're not owning a fractional interest in the underlying real estate. You're owning a share of a fund, whether it's publicly or privately traded. So if you go to the next, yes, sir.
For someone that's like never heard of a DST, like how would you explain this to my 5-year-old? Maybe not my 5-year-old, maybe a 9-year-old. Like what the very simplest thing? I'm selling my real estate. I've got, whatever, $1 million in equity. And I say, Ken, I want to give it to you to do a DST. What is behind that? What does that mean?
So you're basically moving from an active hands-on landlord role to a passive role, where you have an institutional partner who is owning, operating, managing that asset, and your role is passive. And even your debt is actually non-recourse because it's actually debt of the trust itself. So I actually own a fractional interest. So let's say it's a $20 million fund. I exchange $1 million. I actually own 1/20th of that property, but I have an institutional money manager. So that's a syndicated. You have to be what's called an accredited investor, meaning I have to have a net worth exclusive of my personal residence of $1 million or income of 200,000 as an individual or 300,000 as a married couple. What I want to introduce to you now is what we refer to as the sell side DST, which is a little bit different. If you could go to the next slide. So the DST,
Ken, just quickly, while we're on, cut me off if I'm messing up your order, but while we're on the DST, are you going to cover the liquidity picture of that at some point?
Sure.
I just want to make sure we talk about pros and cons of that.
Yep. So one of the things that we see a lot often is how assets or investment properties are titled. So let's say I have a partnership LLC that Bob Harrison and I own a property together in a partnership LLC, and someone comes along and they want to buy our building. Well, maybe Bob wants to do one of these 1031 things. Harrison says, screw it. I just want to cash out and pay the tax and go play golf. And I don't know what I want to do quite yet. Well, the issue that you may have heard of is what's called a drop and swap or a swap and drop. So basically, we all want to go do our own thing. So we have this partnership. So we either have to drop out of the partnership in a non-taxable way to TICs or tenant in common. So we each have our own tenant in common, and then do the exchange as the swap. Or we take our partnership LLC, we complete the swap, and then we drop out to TICs and do our own thing. The problem with that structure is what is referred to as seasoning. If you could go to the next slide for a moment. So seasoning basically says that the court wants to see that there's a certain amount of time that shows that this is for trader business intent. And so there's no defined time period in the IRS code, because someone says, well, how long before I can do one of these drop and swap things? Because we just put the property in the market and we've got a buyer and we all want to go do our own thing. If you talk to different qualified intermediaries, some will say 1 or 2 tax returns, not necessarily calendar years, because again, it's to show the IRS that the intent was not just to evade the taxes, but it was for the intent to continue in that trade or business. I included a couple of court case references on the right hand side. I won't dig into that, but I think in best practices, typically it's somewhere between 1 to 2 tax returns. If you go to the next slide, so the advantage of using a sell side DST is that we can actually take that partnership LLC and convert it into a private DST, and there is no seasoning issue. So if all of us want to do our own thing and we're going to sell this asset, there is no required seasoning. So you can continue deferring the taxes. You play a passive role. Any debt you have can be absorbed by the trust and becomes non-recourse, meaning it's not my balance sheet anymore that's on that debt. And it's not an all or nothing proposition, because someone who's sold a building and maybe they want to downsize, buy something smaller, maybe debt free, but they still have debt to replace, and they still have other assets that would trigger a tax known as boot. You can still use a DST as a kind of a complement to real physical real estate. Next slide, please. And I'm turning the corner here too. I don't want to dwell on this too much. One thing I'll just throw out to you, I mentioned that some people want to pivot from hands-on to maybe like a REIT structure. You can do that through a Delaware statutory trust. It's kind of a nuanced version, which is called a 721 UPREIT, where you have to basically exchange into your fractional interest in a DST. After 2 years, that DST can UPREIT into a REIT, whether that's public or privately traded REIT. And now my ownership is a fractional of that REIT. The advantages are that now I have a path to liquidity where I can sell off some of that REIT, subject to the terms of the REIT. I'm only going to trigger taxes on what I sell, or maybe I want to sit there and enjoy a larger diversified structure and the income received from that REIT. Once you go down the REIT path, you can no longer 1031. So if I went through a DST and maybe I missed being a landlord, it was a great opportunity to buy a piece of property, I can go back and execute a 1031 and go back into real property. Once I go down the 721 path, I can't do that. So if you want to go to the next slide, or I'll pause there if you want me to.
Yeah, can you just talk about the just quickly on either 721 is more complicated, but on a typical Delaware statutory trust, you're typically locked in for 5 years, 4 to 7 years, and then you get the opportunity to either go into another one or take your money, right? That's kind of the structure there.
Yeah, I usually tell people that the average full cycle is somewhere between 5 to 7 years. We've seen them go as short as 2.5 years when real estate was crazy. Typically, if there is any debt, it's interest only debt, which is typically 10 years. So they're not going to go beyond 10 years. And what you need to remember is the sponsor, whether one of these institutional partners, is usually investing right next to you. So they want to execute their business plan, whether it's improving the properties, stabilizing, increasing rents, stabilizing the tenancy, and then liquidating. So they want to move on to their next opportunity too. But at the end of that cycle in a DST, you're absolutely correct. You can decide what you want to do next. Go back into fee simple property, or if you want to continue on a different DST track.
Yep. Yeah, I'll just add my 2 cents. We like DSTs for clients that are concerned, often much older clients. If you're in your 80s and you're concerned that your kids might not get along, even managing a single tenant net lease building, or certainly the existing real estate. The DST creates something where there's no management decisions, there's no buy-sell decision, there's no decision that your children or your heirs will have to make as a group. It's just, when the DST is over, if you pass away and the DST ends, everyone gets their checks and goes home. So it's a great opportunity that avoids that conflict that we so often see. I sit down with 4 siblings that don't talk to each other because they're pissed off about a building on a regular basis. If you get into a DST, at least the real estate won't be a reason your kids are upset with each other.
Yeah.
Okay.
One other thing that you asked me to just touch base on was the lazy 1031, which is not a DST. It's basically another kind of tax mitigation strategy where, let's say I sold my property, I didn't know about 1031s, I didn't know about DSTs, and I call up the qualified intermediary and say, hey, I want to do one of these 1031 things, and they say, well, when's your closing? Oh, it was 2 weeks ago. Too late, because you took constructive receipt and you needed to have an intermediary so the trains left the station on a regular 1031. Well, if in that same calendar year I buy a new property, and let's say I do that cost segregation study, and I drive a lot of deductions, well, those deductions could help offset the taxes you just triggered. But now what you need to keep in mind is, again, what type of tax, because I may need to still materially participate or use the short-term rental loophole for the new asset I buy. Because if I just buy a property and I'm going to have Bob manage it for me and I'm going to be passive, well, a lot of those cost segregations will be suspended passive losses, not necessarily where my pain point is with my active income. So, but it is a good kind of backdoor strategy. One other quick thing I'll just mention too, we hear a lot of people saying, well, listen, I'm going to sell my property, but I'm going to do a cash out refinance in advance of that. Well, you got to be careful. And most qualified intermediaries will say, if you do that, you're going to trigger what's called step transaction doctrine. And basically, it's something that the IRS is saying that you did that in contemplation of evading the taxes. Therefore, we may blow up your entire exchange. So there are structures where you can do what we refer to as the secured loan program, where if it's done correctly and for trade and business intent, you can do a form of a cash out refinance. It is recorded, but then if there's debt that is being replaced through a DST structure, the DST can replace that debt in the exchange, and that you're not going to trigger tax or boot on that. So you got to just be careful. You got to work with an attorney that understands the nuances and the requirements, because you can get yourself in trouble if you just do a cash out refinance and think that you're in the clear. The last slide or two, I'll just wrap up. So we do a lot of tax mitigation planning. It's not just DSTs or 721s. We've got a team of 15 here. We've got 5 CFPs. 2 enrolled agents, 3 CPAs. So we don't do tax preparation. We do more tax planning and tax strategy. So we do a lot in the DST space. We have a portal that we keep up, probably tracking north of 40 different funds and products on a month, week to week basis. And then the last slide, I just left it here as a resource, kind of goes over some of the nuances of 1031, Delaware Statutory Trust, and 721. So it's a free resource if someone wants to download that there.
And I got a question from someone. What are the yields that someone can expect on a DST?
So I'd say it depends upon the sponsor, the asset class, the debt levels, so forth. I'd say a low of, say, 4.25 in the current market to maybe a high of 9, and some of the higher yielding ones might be in the energy sector. So it really depends upon what the client's looking for, and that's net of all fees and expenses too. So I think if you're looking at it on a cap basis, you got to realize that that's a net yield.
Yeah. And are these strategies things that only make sense on, $10 million buildings, or could some of these things like a DST make sense if I've got, 500 grand, a couple $100 grand coming out of a property? Like, would it still work for that?
It certainly could, because you might have a harder time in the marketplace, finding something that has the right debt ratio of an asset you're coming out of. But again, just keep in mind, these are a security product, and you have to be accredited. So if someone doesn't meet the accreditation standard, then it's off the table. But as I said before, it's not an all or nothing. And if let's say I've been a hands-on landlord, I own 3 families in Somerville, but I want to go to a tax-free state. Maybe I want to buy assets in Texas or Florida or Tennessee, where strong MSA, strong population growth. But it would be a little challenging for me to be a distant landlord. Well, this is a way of kind of partnering with an institutional manager, with a track record, have them deal with the tenants and the property, but still get a passive income stream.
Yep. And I'll add one way that we've seen people dip their toes in the DST world is with what's called boot. So they'll sell a building for $3 million. They find the perfect building to buy that costs $2.6 million, and they've got $400,000 outstanding. And yeah, I don't know where you find a $400,000 commercial building to buy. And so they end up talking to someone like Kent, and they say, Kent, I don't want to do a DST with all of this money. I want to own real estate, but I don't want to pay taxes on this little bit. And they'll go out and they'll do 2 or 3 DST investments at let's say 100,000 or 200,000 a piece. So that is a great way, if you find yourself in that position, even if you don't love the idea of the DST, to dip your foot in it, to learn a bit, to avoid paying taxes on that last 10%, 20% of the deal, buy the property that you want in your primary 1031 and use the boot as your back end. Kent, do you have to identify individual DST offerings in the 45 days, or you just say DST?
No, you have to be specific, as it has to be the actual property address in your identification sheet for the qualified intermediary. And Harrison, I would also.
But you don't have to say how much money you would be putting in it, right? Could you vary that?
I would say it depends upon the QI. Some will want the specific property, what the allocation is, because what they want to do is make sure that the debt is going to be completely absorbed. And I'd say that the DST, because it is non-recourse debt, is a great complement to do some soak up some of that debt, which maybe if debt's going to cost me 7, 8, or 8 points in the open market, I don't have the time or interest in going into debt. That debt can be replaced, within the structure of the DST.
100%. I have one more question of my own, but I'll see. Liz, did anybody? Trying to see if we have any questions that have come in. I know I asked a few of them as we were going. But if anyone has any questions, feel free to put in the chat. I'll just quickly ask you. Tell me about the high leverage DSTs real quick, the non-cash flowing, because that, my team's doing more office deals. I know in some parts of the country, multifamily, people are finding themselves in high leverage positions where they've, refinanced the property and they don't have a ton of equity. Tell me about that product.
Yeah, I mean, so those are by design just meant to soak up debt boot. Because you can have taxes triggered by either not replacing the equity, equal amounts of equity or greater, or equals amount of debt or greater. So if someone's coming out of a property, let's say they refinanced and took a lot of capital off the table, maybe they've got a 70% debt ratio. There are DSTs designed to soak up debt, but the problem is you're not going to get any yield off of the DST, and you got to be sensitive to what the fee structure is. So I always like to walk people through, let's do the math in terms of what the tax is. What other tools do we have to address those taxes outside of a DST or high leverage DST in that example, versus if we did it just to soak up boot, but we're not going to get a yield. So it's really kind of a longer term play, and it really is particular to each person's situation.
Yeah, it's another thing that a lot of people may not realize that there's some opportunities out there. So I like to put those on the table. But certainly, thank you, Kent, for your time today. Thank you, Bob. What we wanted to get across with this call is that there's a lot of different options out there, right? It doesn't need to be 0 or 100. Either own your building and deal with the terrible T's, or pay a bunch of taxes and hand a check to your Fidelity guy, or stick the money under your mattress, right? There's some great opportunities out there to keep your building and hire someone like Bob to run it, to 1031 or do a DST or some other structures to avoid the taxes. there's a lot of different ways to solve the question of what's next, right? What do I do when I don't want to do the same thing I've done for the last 5, 10, 20, 30 years? And so absolutely, we'll link Kent and Bob's information when we send out this call in a day or two. If you have any questions, feel free to call me. We're always looking to be a resource, right? If selling makes sense for you, we're happy to explore that with you. But if holding, maximizing your value makes sense, we're in the business of helping people do that as well. Thank you, everyone that joined us on the call, and thank you, Kent and Bob.